All right, everybody, time for a quarterly review. This is something I do every quarter. I just kind of go through my portfolio, go through my trades, and do a little journal entry. So I figured I'd kind of kill two birds with one stone and do a little journal entry, but also just kind of walk you through here's some data that I found and kind of get an idea of where are we heading, So quarter one was pretty choppy, not a lot of clear trends. So we'll just kind of look forward in the future and kind of see what can we decipher as far as different timelines and things like that. So, and just to preface this, like right now, I'm looking for a bottom in this current consolidation that we're in right now. So something that a news headline that I saw is market crash ahead. More than half Americans see the stock market on the horizon of a meltdown. So a lot of fear in the market. So that's a good sign. I like to see that. This one's unrelated to sentiment. So this is a big one. This is the Case-Shiller Home Index. If we're tracking the real estate cycle, we kind of want to start tracking real estate prices and seeing when they might roll over. And you can see that the majority of these largest cities in the US are 0 months off of their all-time highs. So we're nowhere near a top in the real estate market according to this data anyway. There are several cities that are a couple years off their tops, but I want to mention, how close they are to their peaks. So, while they may be off their highs, they're very close to their highs. So anyway, this is good data to see once we start seeing more of these major cities, being 2, 3, 6, 8 months off of their highs consistently. Going to be kind of an indication, and we can go back to the charts and kind of compare this data and see what that looks like on the charts to give us more of an idea. So far, the real estate cycle has been the leading indicator, and then the stock market follows after that. So that's a lot amongst all these fear or recession fears. We're seeing that the data is not showing that that's the kind of environment that we're in right now. So that doesn't mean prices can't go lower and that we can't have a more significant correction from here. But I don't think it's bear market territory. More into the sentiment because this is just a big one right now. I mentioned this in a couple of videos, but this is the AAII Investor Sentiment Survey. And you can just see over the past several weeks, they've just had very bearish sentiment readings. And this is the one I was saying, where if you go back in their history since I think they were in the 80s, these surveys, they get it wrong. The masses get it wrong at the extremes. So that's very typical. So it's good to see that we have a nice, consistent fear in the markets here. If we went back to some of the data in December last year, we would have seen them have some of the highest bullish readings that they've had in a long time. So they usually are most bullish at the peaks and most bearish at the troughs. So I'd like to see that. This one's just a quick little one that I have post-election year. This is from Almanac Trader, years in April since 1950. And you can see that it's kind of a coin flip. The NASDAQ seems pretty good. And that's like a 70% or something like that chance of upside here. But other than that, it's kind of a coin flip. So nothing crazy special about April and post-election years. And that there's another projection that I have for April for Bitcoin and stuff, and it's roughly there, maybe 60%. So I would say a coin toss, nothing statistically significant there. This is another fun chunk of data. This is for April, looking back for honestly, I can't remember how many years and how many cycles this is. But either way, and this would be post-election year. So these dotted lines that are the election year is not what we're tracking. We're tracking these solid lines, right? So you can kind of see how we coming up a little bit in the beginning of the month. I mean, it's up and to the right over the course of the month. Nothing spectacular, but this is when you have to kind of, if markets spend 80% of their time going or deciding where they're going to go, and then 20% of the time actually getting there, you need to be in the market for those short periods of time where it's actually doing its moving. So if you believe that we're not over with the cycle and there's more upside to come, you got to do something with your money. You got to be in the market. Otherwise, you're going to miss. You can see, in these years anyway, if you missed out on these few days, you basically missed out on the whole run. So it's something you kind of have to ask yourself. Are you going to keep waiting for more and more downside to get into the market, or are you going to try to average in a position? You just kind of have to make those decisions for yourself. There is a quote by a pretty famous trader that says more money's been lost in preparation for a correction than the actual correction. So you got to be aware of the your losses basically due to potential, like your potential losses. Gosh, the words eluding me right now, but effectively the risk is not being in the market because you're going to miss out on those opportunities. So a lot of people will sell their positions usually as prices are going down in preparation for worse. And so they sell a small loss and then they're not going to get back in the market until prices are even higher. So lost opportunity cost, that's what I was trying to say. So you have to think of the lost opportunity cost there as well. One thing I wanted to do too, just to like demystify the markets, this is a fund manager survey, and when they're over allocated, under allocated, and do I have a different chart of this? Okay, you can't see the dates down here, but that's okay. What I want to point out is like these people are managing tens of millions of dollars, hundreds of millions of dollars, I don't know, possibly billions of dollars. And it just shows you that even fund managers get it wrong at the extremes as well, because they were max allocated at the very peak of 2021. Typically, you would not think that you would be max allocated at the very top of a bull market. You should be selling more aggressively into the hype and excitement. But they were max allocated long at the very peak, and they were max allocated bearish or under allocated at the very bottom. We don't have the dates here, but this would have been the bottom of the bear market essentially. And then we saw it again in December 2024, where we had that nice expansion. They were max allocated at the top, and then March, which has currently been the low, they're max allocated to the bottom. So I'm not saying that this is the bottom because we don't have enough data yet to see it on the other side. But it's something to be interested in and to understand that you really just have to look at the data yourself or find people smarter than you who know what data to look at, which is what I do. And that's going to be super helpful because there's nothing really super helpful on YouTube about going through raw, boring data, because it might just tell you something that you don't want to know. And we like to confirm our biases. So we typically just look for the information that's going to make us feel comfortable in our investments or make us feel smart or whatever. So you got to be careful of what you're looking for. So, and then I guess I'll just end it. There was another chart there, but it's all the same. It's all the same genre basically. But anyhow, sentiment reading right here, basically all-time high bearish expectations for stock market. And you can see that typically those mark pretty good entry points in the market. This, of course, was the GFC. So, of course, there was a tremendous amount of bearish sentiment here. You can see that signal may not have been a great time to buy in for a leg higher. But, you also had this lower top here. Anyway, no signal is 100%. You got to keep that in mind. But what macro environment were we in during this signal? Basically right now we have increasing global liquidity during this signal. Same probably right here. Market, yes, did go a little bit further, but how much further? It was a good place to start thinking about being interested in the market. You want to be more interested in the market when everybody's so fearful that, all of that fear is already priced in. Anybody who's sold based on that fear, and I say everybody, but not everybody, but it will exhaust sellers eventually. And yes, the sellers will be out of the market. And then the only people left are the long-term holders. And then the short-term speculators have to jump back in as prices continue higher. So there is a ratio basically between long-term holders and then short-term holders and their profits. That's another metric that I can get into later that I should actually do a little bit more research on, but it's a helpful tool to understand where we are as the cycle continues. So why don't we go into more kind of just projections, trying to look ahead to decide whether or not we want to be in the market or not, So I've mentioned this in a couple of videos, but this indicator is pretty cool. This is a 10-year cycle from 1897 to 2024. So quite a bit of data here. And basically what this is doing is it's taking the Dow Jones over the last, more than 100 years and taking a look at each year and what does that look like, and then aggregating that and plotting it on a chart. So years ending in zero, like 1970, 1980, 1990, 2000. And then goes on 2021, 1981, 1921, any years ending in one. And it just goes on in that fashion. And what does a whole 10-year cycle typically look like? And I won't go too much back testing in this because I've done this in other videos, but it's pretty impressive. It's pretty impressive how well it works. It's just as far as kind of a start and end of the year. And as we can see that, years ending in 5, typically the most bullish. So probably a good year historically, according to the data, to be in the market years ending in 5. Now that's not going to work every time, of course, because nothing has a 100% hit rate, but it's a layer, right? If we were clearly in a bear market or something, maybe the year ending in 5 wouldn't play out that particular time. Because like I said, this is over this is over more than 100 years. So obviously not every single year would have looked exactly like that. But overall, as an average, this is what that year looks like. So I like that. This one's a fun one. This will give us a little bit of hope. Quarterly returns for Bitcoin. And what I've done is I usually like to just delete the bear market years because, if we're in a bear market, then we're in a bear market. If we're not in a bear market, or, we don't have that confirmation, I don't really like to use it because, of course, we're probably going to have a negative quarter in a bear market. How many quarters are we getting in a bull market, which we'll actually get into later. But this is great. It has the highest, apart from quarter 4, excuse me, but it has a very high likelihood of ending green. Does that mean it's a mile higher? No, but you'd have to go through here and see some of the returns are pretty, yeah, especially the early days. Like I said, this was a 4% move. So we're not exactly sure how that goes, but either way, April's looking good. Okay, back. Anyhow, so this is a different projection. This is also a custom indicator using the Dow Jones, basically just because it has the most data, and looking back, and then I can select different cycles. So I can say what happened in the market 10 years ago, what happened in the market 20 years ago, 30, 50, 100, and different decade cycles like that will often line up with the current market action, so that you can kind of use that somewhat as a roadmap of what to potentially forecast in the future. And so far, I haven't, as the year goes on, each one of these cycles will probably be a standout, which the market is following even more closely. But kind of like to use it as, this one so far has marked turning points, which is kind of the major thing. So whether the price it exactly follows doesn't necessarily need to. But we can see that we had a turning point in February, and we've also had a turning point in March. Maybe we had that turning point in the middle of the month instead of the end of the month. Time will tell. But either way, it looks like April seemingly close higher, at least the first half of the month strong, and then sideways, and then another period that's going to be potentially, anyway, if we follow this curve, the June, July area, a little less trendy, a little bit more, a little more choppy potentially. And then kind of no surprises later in the year, possibly getting into a low here, August, September area. So that's kind of what I'm looking for. But anyway, just as a broad look at this chart, up and to the right, for this year. So I like the looks of that. And like I said, as time goes on, we'll see which one this tracks more closely, because it may not be this one. I've discussed the other potential of the 20 and 60 year cycle. Doesn't necessarily seem to be lining up much, but we do. But I just wanted to keep this in mind as well, because as it shows going up for March and April, are we really going to print, kind of a double top and then actually bleed into the middle of the year, which would shake a lot of people out, and that would be very uncomfortable, myself included. I don't want to wait that long, but hey, I don't get to choose, do we? So So those are some fun forward indicators that I like to look at just to these are some custom indicators that I have from the Pizzino brothers. If you guys don't follow the Pizzino brothers, you guys could definitely follow them. That's where I get a lot of my data. They're very, very helpful. Um, but yeah, definitely have helped me a lot in my trading and how I view the markets. And they use GAN analysis, so that's the particular style that they're using. What else can we mention here? I guess, yeah, if we're doing a quarterly review, I guess we can go over some of my successes and failures this quarter. Let's go and look at the total three. I'm going to use this particular chart as just a proxy for other altcoins. This is the total altcoin market. And so I will just kind of go through and see. Let me put this on a weekly time frame. And I'm just going to go through and kind of discuss what happened last quarter, which basically, uh, let's see. Yeah, so last quarter, not this most previous quarter, but into the last year, I was able to get into the market around here in a lot of different charts, and I was able to get out very nicely near the top. This because I was noticing this resistance up here in this particular chart, so I didn't expect the entire market to go any higher. I would have kind of imagined that being a barrier for the entire market. So I took a lot of profits right there. That was my most successful trading time, and I was able to turn like $5,000 into 30,000, which is incredible for me. I mean, I would kind of prove to myself like, oh my gosh, like I can do this. This is great, and I actually took some profits. It's hard to do. It's harder than you think. You think it would just be easy to, oh, I'm just gonna. I mean, in hindsight, you're like, oh, I would have bought here and I would have sold here. In real time, it's totally different. So in years past, what I had done is we had got to this stage and I fell victim to the same thing that most people fall victim to is there's so much excitement during these times. It feels like that momentum's there. The energy's there. It really feels like we should be going higher. And so you're really, really excited to buy the dip because, you just had all this proof and all this momentum coming up into this. You can't really imagine that it's going to go any lower. And so this is why most like 90% of everything that I have is in spot, because if the price draws down on me 80%, I can stomach it, and it might take in this case 8 months or more uh, to get my money back. It's not fun, but spot's easier because you have conviction in the cycle to continue going. Yeah, and I think what I've also found this cycle is that it's just really not the game to play. Like you could hold on to it for that 80% drawdown, but you're better off not to because there's just a whole bunch of emotional volatility involved. You might as well just at least take some profits or the bulk of your profits when things are excited and everybody loves crypto. You might as well just get out and then let the market tank because it does, and it'll draw down 80%. And, then you could just put a portion back in the market. You don't have to put it all back in the market. It doesn't have to be all or nothing. But at least you've protected yourself in that way. So that's something I've learned from this zone here is I got in a little bit early and started trying to build leverage positions here. And if you saw on the volatility chart, the volatility was much higher here. So got liquidated on a few positions there. Again, not the bulk of my portfolio, but that was kind of a nasty lesson. So I'm like, okay, well, I'm going to learn my lesson. So I got into the market here, a little bit lower volatility, and as you can see, the swings weren't so great, so it was a little bit easier to hold on and accumulate a position during these times when we had some evidence overbalance in time and price. We are trending upwards. Even though it doesn't seem like it at the time, like this whole run started from back here. But this whole part doesn't feel like that at the time, because it just doesn't feel like it. We just had started, yeah, sorry. We had just started seeing ourselves come out of this bottom. And so it was pretty early days. Anyway, fast forward, learned my lesson there. 8 months later, got back into the market, or 6 months later, got back into the market here with some leverage positions, with some stop losses down here because that would invalidate me, of course, and had a very good run. Like I said, it turned like 5K into 30K. That was huge for me, especially I was going to move with my kid and my wife to a new state, do a new career. I had that nice cushion, right? But then I fell victim to the same thing that I did over here coming up, I'm like, oh, this is working. This is great. You kind of get this confidence back, like, oh, all this research and effort, like it paid off and it worked. I'm like, sweet, like I got this figured out. And then as soon as you think you got this figured out, of course, started getting a little bit too excited and building positions, maybe starting in here and then adding a little here. But of course, leverage in crypto is kind of stupid. But so anyway, then got liquidated and basically at a break even. So all that money that I put in right here, boom, just basically gave it back. So that was a huge learning experience. Good and bad. Now I know that I can do it. Like I'm good at building a position, and I finally sold it. And then it's a matter of looking at the fear and greed. Like it's just huge. I'm going to put this on Bitcoin, but yeah. So if I go back in time, how long does it take from, this peak euphoria to have a market reset and have it bottom and turn around? It's like 4 to 5 months on average is what you need. So sentiment is huge in crypto. That's another lesson here is, if we look right here, what was I doing adding to a position or building a brand new position? I had just sold. I was completely out of the market. I shouldn't have been building a new position while we were still in greed at all these all-time high prices. In hindsight, it seems so crystal clear, like, oh, well, duh. But again, all of this is happening in real time. So I'm just being transparent with you. What have I learned over the time? This is real money that's in the market that I have skin in the game. And like I said, it's about, I mean, honestly, like, well, at one point it was a little higher percentage of my portfolio, but right now it's like maybe 1% of my portfolio. So I could literally have afforded to lose it all. It wouldn't have been fun, but I could have afforded to lose it all because the bulk of my portfolio is in it for the long run. I will probably not play the next cycle like that, and I will probably these pumps here offer 2, 3, 400%. Just take your profits, walk away. 5, 6 months later, when the sentiment has reset and we've hit that extreme fear, I mean, right now is a great time to be building a position. Basically, what I did is I started building here, trying to average down. But of course, if you're leveraged, that it doesn't work. So now what I've done, again, against all better judgment, has started building a position in hype. Down here, even though we don't have the volume back, like there's no confirmation, but I have started to build a position on these levels. I have another position up here at like $25, and so I started to build one here. But the leverage, my new rule is no more than 2x as much as I want to, and there are times where you could use 3x leverage if you really get it right. But the 2x leverage I like because I mean that's a hell of a deal. It's a 2-for-1 deal. And if it's anyway, it allows me to kind of if I only had $5,000 to invest, but I would prefer to invest 10 grand. So I'll use 2x leverage and this is way too early. I'm just gonna say this right now. Like the better thing to do would be to wait for the overbalance in time and price with Bitcoin and have it confirm its uptrend, have the stock markets confirm its uptrend. I should not do this on leverage. Like honestly, in spot, I'd be okay because I could withstand 30-40% drawdown and actually not sweat it. But anyway, it's kind of neither here nor there. That's what I'm doing. I'm just being transparent. I like to be in the market, and I like to get as low as I can. Not the low, but I just like to have the lowest average price. So I just figure now that we've had this extreme fear, we have kind of a sentiment starting to rise again. We are still like a month away from if you were to, do that 4 to 5 months that I was talking about, we still have another month, within that 4 to 5 month range to where we could bottom. We could see lower prices from here. I'm not saying that it's the exact low. But so far we are, got all these drawings on here. So far we are holding nicely above this trend line. So we're just going to have to see. And it may be a thing where I have to puke my position right here and get out if prices fail or if we go below here. But so far this has proven to be decent support. Perhaps this will be a double bottom. Time will tell. We'll just have to watch the volume come back in the market and see what's happening there. Overall, depending on what data is going to prove to matter in the end. The global liquidity projections that we have seem to have a rise in global liquidity over April and May. So we will hopefully start to see some higher prices climbing out of here. The other thing I wanted to mention too, right now we are in some uncertainty, some tariff uncertainty, and but oh boy, now I gotta find the right chart. Oh boy, where did I do this? Hmm. And I just did this too. Oh, that's right. Sorry. I did it on the S&P 500. We're a little unscripted around here. Okay. Yeah. So stock market, I just wanted to mention too. We started talking about sentiment and all these that kind of helping identify where a low should be forming. We don't have confirmation of this low until prices are higher. That's the way it is. So getting in down here is technically riskier because you have less confirmation and you will pay an insurance premium by waiting for prices to rise out of these levels. But anyway, as we go back, we can see previous in the year, the previous measured correction I have here was the yen carry trade unwind. There was a lot of fears there. And so far, this has proven to be a measured correction. It's eerily equal, like just hit price and time right on the button, and currently holding above that. So we'll have to see how that holds. But the good news is that between peak fear and peak fear, we have a higher low, which increases the chances that we're going to see higher prices from here. And then we go back here, we have the Israel-Iran conflict. That was the other major fear. And this is just something that's good to keep track of in general as you come across major news events. Hindsight's what ends up proving these to be the lows. You can kind of mark them up on your charts, and it kind of starts to paint a picture that these markets just climb that wall of worry. So anyway, time is going to tell over this quarter whether this was the low or if we get one other leg lower. We just don't know. And whether we climb higher from here, how clear that's going to be, we will see. I mean, we may be up only from here, but it may not feel like up only from here because, of course, markets just don't move in a straight line. So we just have to keep that in mind. One other signal that's popped up here is the Gann 3-time breakout rule, where price meets a point a few times, and the next time, if it breaks out, if it gets that confirmation, then it's typically a genuine breakout. Use this signal quite a few times, and it's just very helpful. It doesn't always play out, and you kind of have to backtest probably per market to see how effective it is and on what time frame you're using. But over a long period of time, I think is an even stronger signal. So that's just something to keep in mind too. We'll see if we end up getting that one. Dollar's really weak. USDT dominance is the last I usually like to look at. And again and again and again, we we do not want to see us break this trend line to the upside because that'll be a lot more pain in crypto. But after that, then maybe that's where the buy the dip opportunity comes in. Time will tell. Time will tell there. So I think that's about all I have from here. Major lessons too. Oh, one last major lesson that I was just absolutely so did a good thing and did a bad thing. I guess good and bad. One of my very original positions ever. I started back in 2023. I bought H bar at 7 cents, which seems pretty good. I mean, that's pretty good for buying the low, especially after a couple years of prices going down. And then actually was able to buy in right here. That was a very good buy here. And what I ended up doing, which is the harebrained move, if you look at this, just zoom out, we're basically just in kind of a giant trading range. And what happened is as prices came down here, I was at a crossroads. I was like, well, if it breaks down from here, it's going to be pretty hurtful. And so I sold I think a little bit more than half my position. And yes, I had a higher buy here, but this it has ended up being a break-even trade for me because I was earning a lot of interest in H bar. So that was kind of the good and the bad of it. I was like, well, I can ditch half of my position here at a break even, and I can be happy knowing that I protected myself a little bit. But I knew, I think I literally sold it like the week before, and I had a very, I just knew better. I was like, this is a trading range. We just haven't, this chart hasn't broken out of its bottoming structure yet. And so I felt like it was more likely that this would be the highest probability of a bounce. And that is what ended up happening. So the good and the bad is I had half of my position that I had a good return on, and I protected myself. So afterwards, it feels a little bit more painful, but but which one can you live with? You know, if prices went down any further, that would have been a lot more painful. So I just wanted to share that one. And this is over the course of several years. So, you know, that's why I kind of have adopted more instead of holding all cycle, which you can do. You know, I mean, this was at let me measure this. I mean, this was at this time, you know, a 200% gain. So, you know, it would have been nice to take my 200%, walk away, and then maybe when prices come down here, as I had that conviction of, oh, we're in a trading range, we haven't bottomed out of, we haven't come out of this bottoming structure, high probability area of a bounce. Maybe I could have put half of my profits back in, you know, not adding 100% risk, you know, and then come up and maybe known this is the bull bear market range. And this was a very high probability of a turnaround, which you can see is what happened. And if I sold even just a little bit under that, 460%, that'd be a 5x gain on a portion of the profits that I had from this trade. So uh, the takeaway from there is that everything's hindsight, but have a plan. So as prices came down here, I had a plan. Well, first of all, I had a plan. I wanted to earn interest on my H bar to just help buffer any of the downside. I was getting a tremendous yield so that even though prices came down basically to my original buy and I had averaged my price up slightly here, the interest that I had earned averaged my price down here to where I was at a break even. So that was my plan there. I'm going to earn interest on this to kind of help hedge a little bit some of the potential downside in the future. And then that's what happened. So then I sold at the worst time, but also knowing myself, what can I live with? I have to know myself as a trader. And I would have to say that after holding this thing for 2 years and seeing a 500% increase, then just to watch at a loss 2 years later, can I really, can I stomach that? And I can't stomach that. What I can stomach with is getting half of the gains that I was anticipating. So that's it. And that's what I want to do on this channel. Like everybody, I just want to be real with you, and because the hard truth of it is that there is no easy way, and some lessons do have to be learned the hard way, and the only way to study and study and study as much as you can and backtest as much as you can, but ultimately the only way to do it is to get in the trenches and do it yourself and learn your own lessons. So I will try to you know, teach as much as I can and my lessons and what I'm learning from what I learned from the pros, and what I, you know, when I don't follow the advice, and when I do follow the advice, when it works out, when it doesn't work out. So yeah, all in all, looking like 2025 is going to be a good year. This is just a beautiful bull market, climbing nice and steady to the upside. Just because I'm curious. Yeah, and we're still nicely within trend here. Nicely within trend here. And this is actually also typical of markets. As you start off, you kind of have this rate of growth, and then it accelerates a little bit, and then we will just see what happens in the future here. Yeah, I mean, we will just kind of see what happens in the future here, and you know, perhaps we kind of steepen up a little bit. That kind of happens as, you know, as the cycle continues and we get more and more excitement, more and more money involved, more volatility involved. Yeah. So anyway, overall, looking like we're nearing a low. It seems to be respecting this trend line, and yeah, I'm just going to see how the dust settles. So again, starting to accumulate a position during lower volatility and during the lows is a good idea. I'm using leverage. I don't advise that to anybody necessarily. but I know what risk I'm taking, and I know that if I get liquidated, that dollar amount is what I was willing to lose on that, and that maybe that gives me 2 or 3 opportunities to get into a trade and be wrong before it actually goes the way that we're anticipating in the longer overall bear market. So anyway, that was a long one, but it is time for a quarterly review, and I just kind of wanted to go through and just kind of showcase how I go through and look at some of the data and how do I apply it to my trading. So far right now, looks like we've broken this cup and handle pattern here. Cup and handle pattern here on a macro scale, coming back down for a retest. In the future, this is just going to look like absolute textbook, is my theory and my thesis. So anyway, I think that about wraps it up. Until next time.